Good evening, everyone. You're in the right place. This is tonight's program, 10 Steps to a Smarter Tax Return. I am just opening up the doors and watching all of the participant counts rising. So we are recording tonight's program. We will be starting momentarily. We have over 60 people registered, and this is the fun part where I open the door like I'm hosting a gathering, which is what we are. And I'm watching those numbers climb. Thank you for making time to spend with us this evening on this topic. Okay, so we are going to keep those doors open, and we're going to be very respectful of everyone's time that got here at 6:30. Allow me to introduce myself. My name is Patty Smolin. I am your business liaison librarian with the Schaumburg Township District Library. I am very pleased to share with you that I just marked my 9-year anniversary on the 9th. So way to go, me. Really, really happy. It's been close to a decade of serving the Schaumburg service area and doing the work that I love in business reference. The nature of my work is to focus on those interested in financial literacy, which tonight's topic hits the mark for. Also to help those that are in job seeking mode or starting a business or looking to grow a business. Of course, I work with the rest of my reference department colleagues in offering various areas of general reference, but those are the 3 areas in my primary focus. I do want to welcome Karen Shan to us once again. Working with Karen is always a pleasure. Tonight's program, 10 Steps to a Smarter Tax Return, I think comes in a very timely way. So I'm just going to read a very brief summary of what it looked like in our program guide and online. So instead of just doing your taxes next year, take steps to manage your tax bill now and in the future. Join Karen Shan to learn to make smart choices about when and how you save for retirement or college. Use employer benefits, pay taxes on your investments, manage the tax hit of being a widow or widower, or take advantage of lower income years at the beginning or end of your career. Tonight's program is being recorded and it will be posted to our YouTube channel. The handouts for tonight will be sent in a BCC and a blind carbon copy to those of you that provided email addresses to us. I'm going to put my email address in the chat feature. Should you have any questions for me on behalf of the library? And I would like to turn this over to Karen and say welcome back. Thank you again for bringing another quality session to us.
Thank you, Patty, and thank you to everybody for coming. I actually had a little internet glitch on my end while Patty was doing the introduction. So Patty, could you just speak up and let me know, does everything look okay, sound okay?
You sound okay, and I'm about to take myself off the screen and mute my screen, but your content needs to come back up again.
Okay.
You want to go back to the share screen? It was there just a moment ago.
I know, but I literally had to change internet providers in the middle of that. So let's try this again. All right, we should be good to go.
And now it is. 10 Steps to a Smarter Tax Return is on the screen.
Okay. All right, thanks, Patty. Sorry for that tiny little glitch there. The moral of the story is when you change cell phone providers and you change internet providers, be prepared for there to be a lot more time and effort involved than you ever planned for. That's the moral of my experience over the last couple of weeks. But we're not here to talk about those kinds of things. We're here to talk about taxes. And since I did have to be out for a slight bit there, I know Patty was introducing me. I didn't hear what she said, so just in case these are things she didn't say, I am a certified financial planner. That's why I teach the topics that I teach. However, I do not take clients. I got that certification so I could do a better job with education, and I am education only. As I have been for 29 years as of this year, 18 of those years with the University of Illinois Extension, on my own for the last 10 years or so. So a couple of ground rules for today. This is education and not advice. The difference is I hope you will leave saying in your mind things like, I learned about this and I'm going to either look into myself or talk to my financial advisors about what that means for my situation. Rather than saying Karen Chan said I should fill in the blank. Also, tonight is not about how to prepare your taxes. The goal is to help you understand some of the concepts behind our income tax system so that you can understand better, why some of the things work the way they do, what the impact of some of your decisions might be. And because we're kind of in a transition point here, where I talk about dollar amounts, I have generally provided both 2022 and 2023 figures. 2023 will be always the second number. And it may be that after tonight's program, you feel a need to consult a qualified financial professional and get advice specific to your situation. I won't be surprised. You may be, as I've called it sometimes, confused at a higher level when we finish tonight. I do have links to a fair amount of additional information on the strategies that we're talking about tonight. Those are all posted in one place where you'll be able to click and go directly to any of the resources. There's no login, there's nothing like that. You just go directly to KarenChanFinancialEd.com. There's a resources tab and you click on something like 10 steps to a smarter tax return on the list, or type in the URL as you see it here, and you'll have access to all of those links. Now, we're covering a fair amount of territory tonight. And some of the things I talk about will be relevant for any and everybody, but there are others that are really only relevant for particular audiences. And so, for example, if you're employed versus retired, certain of today's ideas will be more appropriate for you than others. If you're early in your career, if you are widowed or married, and if we're married at some point, we either suffer loss of a spouse or divorce. Those are the only two choices, or we go first. We'll talk about things that apply in those situations as well. And we're going to start with what, in my opinion, is one of the most misunderstood features, the second most understood feature of our tax system, and that is deductions. I had a colleague years ago who told me that he had somebody prepare his taxes, and every year he said he prepared a list of all these various kinds of expenses and gave it to him because they were deductible. And when he told me the kinds of expenses he was handing over to this person, I was pretty sure that there were no deductions being received on these kinds of expenses. But he was convinced that there were, because he didn't understand the fine print. And so my goal tonight is to help you understand how deductions actually work in our system. First of all, there are two ways to claim most deductions. Either to take a standard deduction, which means it's a standard amount depending on your filing status as single or married filing jointly, or an adult, unmarried adult with children in the home, or to itemize deductions. And the good news is that you get to take whichever of these two numbers is higher. If the standard deduction is greater than the expenses that would be itemizable, then you take the standard amount. And over time, with tax law changes, more and more of us are using the standard deduction. Actually, since the last big tax revision in 2018, only about 10% of people are itemizing. And so some of the things that you've been thinking you were getting a tax benefit from might no longer be true. Here's why most of us are not itemizing any longer. Because the standard deduction for 2022 for a single individual is right at $13,000. For head of household, almost $20,000. For married filing jointly, almost $26,000. And you don't have to do anything to be able to deduct those amounts. And as you can see, they'll go up slightly for 2023. Now, there are people who still itemize, and so I do want to review what are itemizable deductions. Medical and dental expenses, but only to the extent that they exceed 7.5% of your adjusted gross income. For most of us, that means that we have to have substantial medical and dental expenses. The main time we see these happen, expenses of this amount, are with catastrophic illness, maybe where you have a high deductible health plan, and so your out-of-pocket expenses really can skyrocket, or for someone who is needing extensive skilled nursing care. For example, an older adult who's suffering from a chronic illness and is in a skilled nursing facility. Those are the kinds of situations where we see this mostly happen. The other expenses that we're accustomed to thinking of as being deductible are real estate taxes and state income taxes, or you can choose sales tax as the alternative. But starting in 2018 and going through 2026, the limit on how much you can deduct for all of these together, which are referred to as SALT, state and local taxes, SALT, your SALT taxes are limited to $10,000 to deduct. Well, if you're a homeowner in Northern Illinois, your property taxes alone can pretty much max out that $10,000, meaning you're getting no deduction. You can't take any deduction for any additional state income taxes or sales taxes. Third main category is home mortgage interest and points, but only if the money is used to buy, build, or improve. So refinances where you took money out to do other things aren't so clear cut now as far as the deductibility of the interest and so forth on those. And then charitable contributions, not unlimited, but typically you're allowed to deduct charitable contributions up to a certain percentage of your income. So as I've gone through these, maybe you've been toting things up in your mind and thinking, oh, yeah, we've got about $10,000 of we're going to hit the $10,000 limit for the real estate and state income tax. Yeah, we've got mortgage interest, not sure how much it is, but it's a few $1,000s for sure. Yes, we do some charitable contributions, but the question is, depending on your filing status, does the amount of your itemized deductions exceed the amount that you could take as a standard deduction for your filing category based on generally your marital status? For most people, the answer ends up being no today. Now, looking ahead, there may be changes coming up in 2026. We could go back, barring additional legislation. The current law will sunset and we will go back to the standard deduction calculation that we had before, which would take it back to about half what it is now. At the same time, you would probably see exemptions return. And so for some people, the net change was not very large, but these are a couple of things that may be happening. But again, in 2026, we could be going back also to where wealthier individuals may have a limit on how much they can itemize for those making over $400,000. Verdict is still out. Will the current tax program be extended, or will we revert to the previous rules? Probably won't know the answer to that until 2025. But here's some good news. There are some, and I put deductions in quotes here because technically on the forms that we file now, they're not labeled as deductions, but there are some subtractions from income, is what we'll call them, that don't require itemizing. They fall outside those categories. And these are reflected thinking about the current tax forms that we fill out. We have the 1040, which is the main document. Then we have attachments, generally referred to as schedules. And so Schedule 1 is where you have adjustments to income, both additions and subtractions. But here are some of the adjustments to income that would be subtractions that do not require itemizing. If you're making contributions to a deductible IRA, that will be subtracted from income, provided you meet some income limits if you also have an employer plan at work. Student loan interest is a deduction that falls here. If you are making contributions to a health savings account that you're contributing to directly, it's not coming out of your paycheck, this is where you get the deduction for those HSA contributions. And for self-employed individuals, This is where you get credit for retirement plan contributions, for paying health insurance and long-term care insurance premiums, and for that extra half of your Social Security and self-employment tax that you pay as a self-employed person. So these are those adjustments to income that you don't have to itemize to get these. They're reported on Schedule 1 as opposed to the itemized deductions form. And just in case you were wondering, you may have been thinking, oh, but wait, you mentioned charitable deductions being itemized. Wasn't there something where we could claim either $300 or $600 of charitable deductions, whether or not we itemized? Is the operative word there. That ended with 2021. That is no longer available as of your 2022 taxes that you'll be filing in the spring. All right. Let's talk about strategy number 3, if we want to call these strategies, of ways that you may be able to manage your tax burden to some degree. And it's deferring tax, meaning not paying it now, but having an agreement that you'll be paying it later. Tax deferral works best if you expect to be in a lower tax bracket later on, when the tax will actually be due. You know, when tax deferral first became a thing, 30 years ago or so, most of us expected to be in a lower tax bracket when we retired. That's not necessarily true anymore. So it's not always 100% sure that deferring tax in and of itself is helpful, but we'll talk about some other reasons that it could be. First of all, let's talk about where we defer taxes. The biggest place that we do this is in retirement accounts, tax deferred retirement accounts, as opposed to Roth retirement plans. And so if you work for an employer that offers a 401k, 403b, 457, in all of those, you're going to have the option to contribute to a traditional arrangement where you are not paying tax on that income. It's actually removed from the income reported on your W-2. So it's not technically a deduction, but it's not reported income. Traditional IRAs do the same thing. The one thing that's different about them is that you actually deduct them on your tax form because it's not done through the employer. There's, the employer's W-2 can only remove wages that were paid out of your paycheck for these employer plans. IRA, you're doing it yourself. So that's reported on your 1040 itself. And another thing that changed in the last few years, starting in 2020, doesn't matter how old you are, you can put money into a traditional IRA as long as you have earned income. It used to be that beyond age 70 and a half, you could no longer contribute to an IRA, even if you were working full time. Now you can. But again, tax deferred retirement accounts give you the best result if your current tax bracket is higher than you expect it to be in retirement when you will pull the money out. One thing that brings that assumption into question is that tax rates, barring additional legislation, tax rates are going to rise in 2026 when the current law expires. However, if you do experience a drop in income during retirement, that may compensate and still put you in either the same or lower tax bracket. For many people, it's those required minimum distributions that make the difference. If you've done a great job saving in tax deferred retirement plans, once you are forced to start taking those required minimum distributions, that will be taxable income, can push you back up into a higher tax bracket than you might have expected. So what could be better than tax deferral? Maybe tax-free growth, if we can get that, because that will reduce future taxable income and therefore reduce taxes that we owe in the future. How do we get tax-free growth? The main way is through the Roth version of our retirement plans. How do you qualify for those tax-free distributions? The distributions of growth are tax-free if the account has been open at least 5 years, and you have to check both these boxes. You're either 59 and a half, dead, or disabled. Check both those boxes, distributions of all the growth will be tax-free. Why are we focusing on growth? Because the contributions are going to be taken out tax-free anyway. You didn't get a deduction in the year you put the money in. Your contributions are money you already paid tax on. You will not pay tax again. And so contributions, whenever they're taken out, are always tax-free. It's the growth that we have to qualify for. Special rule for Roth IRAs, only IRAs and only Roth IRAs. When you take money from a retirement account, a Roth retirement account, the general rule is, well, for any retirement account, the general rule is it's a mixture of contributions and growth. It's called the cream in the coffee rule, that once you've mixed, once the money gets mixed up in the account, you really can't identify which dollar came from contributions and which dollar was part of the growth. And so when you take it out, it's proportional based on the amount you contributed and the proportion that represents of the total value of the account. But with Roth IRAs, distributions are deemed to come from contributions first. And only once you have exhausted all of your contributions, then the remaining distributions are considered to come from growth when tax and/or penalties could be an issue. Now, to be honest, if you're approaching the end of your working years or you're already past the end of your working years, this isn't a really big deal because you've probably already qualified that your distributions of growth are going to be tax-free anyway. Doesn't matter to you whether your initial contributions are said to be a mixture or if they're contributions only when you take the money out. But for younger people, this can be very important. Case in point, my niece, one of my nieces, several years ago, relatively new in the workforce, not really making very much money, but somehow managed to not only have an emergency fund, but had some extra dollars she felt that she could put into a retirement account. She was a little nervous about it. And so she decided, rather than putting money into a traditional IRA, which would have given her a tax deduction, but her income was so low, she owed almost no tax anyway, not a big benefit to take a deduction for the IRA contribution. So she put her money into a Roth IRA. No deduction in the year she made the contribution. But again, like I said, she owed very little income tax anyway. But what it gave her was knowing that if in another 3 years or 8 years or 15 years, if something bad happened and she needed money, that she would be able to draw those contributions out of the Roth IRA tax-free, penalty-free, without having to worry about the growth. Because obviously, if she was 35, she wasn't going to qualify for tax-free growth to be pulled out. Not an issue, because with the Roth IRA, distributions come first from contributions. Only later are you taking out the growth. Another way, I'm sorry, hold on a second. I'm on old internet right now. I had to switch. Thank you. I think my husband just realized our internet problem. He was checking to make sure I was actually able to be with you guys tonight. Okay, the second way that we have access to tax-free growth is through college savings plans, where you put money into the plan, maybe for a child, for a grandchild. Later on, you take the money out. If you use it for qualifying expenses, the growth is going to be tax-free. The types of accounts that work like this are the Coverdell Education Savings Accounts, which were modeled on IRAs, and you may still hear them perhaps colloquially referred to as education IRAs, but also the 529 plans, both the prepaid tuition version and the savings plans. Those all will give you tax-free growth if the money in them is used for qualifying education expenses. And if you contribute to an Illinois 529 plan, in the year you contribute, you will also get a credit toward your state income taxes. So college savings plans can be quite beneficial from a tax perspective. Moving on to idea number 3 for reducing or managing our income tax burden. Wouldn't it be great if you could get part of your wages without paying any tax on them? To be honest, you've been probably doing this without even realizing it, because to a certain extent, there's somewhere you don't have to do anything. Others of these take positive action on your part. This is even more powerful than tax deferral or tax-free growth, because we're talking about the actual part of your wages that you will never pay tax on. Pretty darn good, right? And I mean, will not pay tax on this money ever. So you can avoid not only income tax, but also the Social Security and Medicare tax. I've said FICA here because that's the technical term for your Social Security deduction. You can avoid all of those taxes on your income to the extent that you're using it to pay for health and dental insurance premiums through your employer, meaning it comes out of your paycheck, educational assistance provided by your employer. Also, those flexible spending accounts that are in the news right now because we're approaching the end of the year, and flexible spending accounts are use it or lose it programs, meaning that you had money taken from your paycheck over the course of the year and deposited into a flexible spending account. You might be using one that's for healthcare specifically. You might be using one that's for dependent care specifically, or even to a smaller degree for commuter expenses. You put money into these plans, you're able to take money out to reimburse yourself for qualifying expenses. Obviously, medical expenses if it's a healthcare FSA, dependent care expenses if it's a dependent care FSA account, so on. The money you put into these plans, you will never pay any income tax or Social Security or Medicare tax on. But you have to be careful that you're putting in an amount that you know you can actually use over the course of the year. Now, during the first 2 years of the pandemic, there were special rules put in place that allowed you to roll over a significant amount of money if you had not been able to use it. That's not happening this year. So you're going to be under the standard rules that may give you, depending on your plan, may give you a couple of extra months for expenses or may let you roll over a small amount, depends on the rules of your particular plan. So if you're using this already, go check. If you're not using these yet, if your open enrollment period at work is still going on, look into whether you should be signing up for some of these for next year to have tax-free earnings. The last one on my list here is a health savings account. Sounds very similar to that healthcare flexible spending account, but operates quite differently because this is not a use it or lose it program. You're avoiding all of these taxes if you're funding your health savings account through your paycheck. Remember, I mentioned earlier, you might be funding a health savings account directly yourself, paying into the fund. In that case, it's an adjustment to income on Schedule 1. But if you're doing it through your employer, you will already automatically be avoiding not only income tax, but also FICA and Medicare. But I need to tell you more about these health savings accounts. Not just everybody can have one. You have to have a health insurance plan that is a high deductible health plan. That means that your health plan has to have deductibles that are at least, for the past year, it was $1,400 for an individual plan, $2,800 for family. Next year, it goes up a little bit. The deductible would have to be at least $1,500 for an individual or $3,000 for 2023. You have contribution limits. By the way, these limits go through April 15th. For 2022, if your health plan covers just you, you could contribute up to $3,650, depending on your tax bracket. That might mean $700 and some of savings in taxes, actually more, because that would just be the income tax part. If you're a family health plan, then you could contribute up to $7,300. And again, then we're talking perhaps as much as $1,500 or even more in tax savings. 2023, the numbers go up again. And if the account owner is over age 55, then you can put in an extra $1,000 per year. Here's where health savings accounts get very interesting. When you take the money out, when you withdraw the funds, if they are used for qualified healthcare expenses, there is no tax. Well, no surprise there. We told you this was going to be tax-free, right? But here's where it gets interestinger and interestinger. You're the one who decides when you want to request reimbursement. I told you at the beginning, this isn't like a flexible spending account where it's use it or lose it by year end. This is your money, period. End of story. And you get to decide, even if you want to get reimbursed for healthcare expenses from 2022, you don't have to request that reimbursement this year. Under current rules, you could wait as long as you want. You could wait 5 years, 10 years before you ask for reimbursement for these qualified medical expenses, which leads us to the strategy that many wealthy people are using. As you go along, you simply pay out of pocket with regular money for your healthcare expenses. But you continue to fully fund your healthcare savings account and you let it grow untouched, tax-free. Eventually, you will take the money out to reimburse yourself for healthcare expenses. And at that time, you will receive tax-free growth. But remember, this is something where you already got a tax deduction on the front end. You avoided taxes on the money that you put in. Now you're going to get tax-free growth on top of that. This is the only opportunity under our tax plan in the United States that allows that. So if you have access to a health savings account, consider how you might use it this way. Now, having said all that, if you're living pretty much paycheck to paycheck, if paying the bills isn't even easy every month, then you may not have the luxury of leaving the money sitting in your health savings account. But if you can, it could be a very helpful thing down the road. Okay. Number 6 is sort of a warning more than a strategy, but it's letting you know that helpful types of income may or may not be taxable. We need to know that they may be. That's where the nasty surprises can come. You know, during the pandemic, many people went through a period of unemployment. Always, we have unemployment insurance for people who lose jobs who are not fired for cause. They were enhanced during the pandemic. And those unemployment benefits are taxable income. A lot of folks don't realize that. And so when they get this 1099 come January or February saying, here's unemployment income, and now you get to pay income tax on it, it kind of feels like salt in the wound, but those are the rules. There was an exception provided by the American Rescue Plan where tax was waived on the first $10,000 for unemployment benefits for 2020 if you met the income requirements, but that was a one-time thing. So the general rule is unemployment benefits will be taxable income. If you know somebody who's received them this year, you might just kind of give them a heads up to make sure that this doesn't catch them off guard. They might end up with an underpayment penalty when they file their taxes. You might be able to save them that surprise and embarrassment. Another thing that is helpful income, but could have a little surprise, and that is that debt forgiveness is generally taxable income. The federal income tax rule is that forgiven debt is taxable income unless the IRS or federal law says otherwise. Now, state laws may differ, but for the most part, if somebody forgives a debt, doesn't matter what kind of debt it is, you can expect to get a 1099 for debt forgiveness and have to report that income. But I want to focus mainly right now on student loan forgiveness. We have some permanent rules, and then we have some temporary rules that I need to talk about here. The permanent rules for student loan forgiveness are, if you're in an income-driven repayment plan, which by design could mean that when you finish your repayment plan, there is a balance still on the account, which will be forgiven. That debt forgiveness is taxable income. You finish your income-driven repayment plan, depending on your income and other factors, you may or may not have a balance at the end, but to be honest, the goal of being in an income-driven repayment plan is that you won't have to repay the whole amount. So whether it's $2,000 or $20,000, that will be taxable income. However, if you receive student loan forgiveness through the Public Service Loan Forgiveness Plan, often abbreviated as PSLF. If you receive forgiveness through public service loan forgiveness, by statute, by law, that is not taxable income, which is a nice gift along with the loan forgiveness. Now, going back to the pandemic again, when the American Rescue Plan was signed into law, it specifies that any student loan debt discharged after December 31st of 2020 and before January 1st of 2026 is not taxable income. What this means is that for the next 3 years, any type of student loan forgiveness will not be taxable income. So if you finish up an income-driven repayment plan in the next 3 years, or did it in the past 2 years, that's not going to be taxable income, even though the permanent rules say that it would be. And if Biden's student loan forgiveness plan makes it into reality, right now it's on hold because of some challenges through the courts. If it goes into effect, and if it happens before January 1 of 2026, that loan forgiveness would also be non-taxable because of the American Rescue Plan rule that was put in place 2 years ago. One other way that you might receive debt forgiveness is from mortgage forgiveness. There's a specific thing called discharge of qualified personal residence indebtedness. If you qualify for that and that type of forgiveness happens before 2026, it won't be taxed as income. However, you'll have to report it on your tax return. So I should have had this slide mirror the prior one, that the general rule is mortgage forgiveness is taxable income. But again, because of the American Rescue Plan, mortgage forgiveness that qualifies under this rule that happens before 2026 will not be taxable income. Just recognize that this is a temporary rule. After 2026, mortgage forgiveness will once again be taxable income unless another law is passed. Two things I want to say before I move to the next slide here. First of all, Patty is going to be emailing you the slides tonight after the program. As we're going through here, if there is a slide that you know is pertinent to you that you want to come back and look at, notice that the slide numbers are down here in the right-hand corner on almost every slide. To make things easier for you, make a note of the slide numbers that you want to come back to, so that when you get that email from Patty, you can just go directly to the piece of the presentation that was relevant for you. And if you decide to listen to a replay of the recording, that will also help you get back to the part that you most wanted to hear. Now, second thing, there is something new that's happening for 2023. I'm sorry, it's actually for 2022. It will happen when you're filing your taxes in the spring. That could be a surprise for you. I don't have a slide about it, but it's about something called a 1099-K. If you have been selling items or have otherwise been receiving money through third-party payers, such as PayPal, eBay, Venmo, if you're receiving money from those types of third-party money transfer companies, you may receive a 1099-K next year. The intent is that is to be taxed only, that income, well, the only income that will be reported on those forms will be business income, rather than, you know, you're paying your buddy back for paying for dinner the other night when both of you split the bill. Those types of transactions are not taxable. The question is how clear, how well the third-party payers are going to be able to distinguish between business transactions and just personal, you know, gifts and reimbursing expenses. But if you've been selling items, for example, on eBay in particular, or maybe even Facebook Marketplace, don't be surprised if you get a 1099. You may need to do a little bit of reading about how to handle that if you do. So this is just a heads up that you might get something you hadn't expected, because these are new rules. the rules about what income is taxable have not changed. What has changed is the reporting requirements for these third-party payers. Until this year, you could receive significant amount of money. I think it was $20,000 before you would get a 1099, say from PayPal or from eBay. Or if you had some large number of transactions, I want to say it was around 200. This year, if you got $600 or more, you're going to get a 1099. So just a heads up on that piece. All right, let's now take a, not a break, but switch gears here in the middle before we go into some of the more involved topics I want to talk about. I need to make sure that you actually understand some of the basics of how our tax system works. And once you hear it, I don't think you'll find it confusing, but if nobody's explained this to you before, you may simply not know this. First of all, you've probably heard our tax system referred to as a marginal tax system or a progressive tax system, and you've heard the word tax brackets. You hear people talk about being in the 22% tax bracket or the 24% tax bracket, but most of us don't fully understand what that means. That's going to change in the next 3 minutes. This is my depiction of how the marginal tax system in the United States works. What you've got here is a list of the breakpoints for a single tax filer and the breakpoints for a couple married filing jointly. These are for 2022 numbers. These show you what bracket your income based on your taxable income. Now, this is not adjusted gross. This is taxable income, the actual amount that you pay taxes on. So let's just pick a number here. Let's say that you are single and your total taxable income is $70,000. You earned more than that, but some of it wasn't taxable. And so $70,000, that's between 41 and 89. That means that you're in this pretty little green box right here. What does that tell us? It means that you're in the 22% marginal tax bracket. Marginal. That means that you paid 22% on these last dollars of your income. But the other dollars of income, some of them were taxed at 12%, some were taxed at 10%, and some of it wasn't taxed at all because you got that standard deduction for one thing and maybe other subtractions from income. So if you've ever heard somebody say, oh, I got a raise, but my take-home pay was less because it put me in a higher tax bracket, can't happen. Because let's say that this person got a big raise and next year they move up to the 24% tax bracket. You only pay 24% on that extra income above the $89,000 for this single person or above $178,000 for the married couple. You still paid 22% on this much of your money and 12% on this much of your money and so on and so forth. So this is what we mean by marginal tax brackets. And this is what provides opportunity in years when maybe your income is lower and you're in a lower tax bracket compared to later on, as far as you have control over when you receive certain kinds of income, you can actually make use of the tax bracket system. Okay, hopefully that made sense. Now we're going to add a layer of complexity to it. This is what we just talked about, that for ordinary income, we have the same tax brackets that I just showed you before, and we refer to that as your marginal rate. But notice now I'm referring to ordinary income. Ordinary income for many of us is most, if not all, of our income. It's wages, it's interest, it's self-employed income. But if you're receiving long-term capital gains on investments, or if you have stocks that pay dividends, most of those dividends will be what we call qualifying dividends. They have different tax rates from the rest of your money. So let's say that your total income puts you in either the 10% or the 12% marginal tax bracket. That means that If you have long-term capital gains or qualifying dividends, you pay no tax. Your tax rate is 0 on those things. If you're in the 24% tax bracket based on your total income, you're only going to pay 15% tax rate on your long-term capital gains and qualifying dividends. Now, I've put 18.8 in brackets here, and I've also given you a higher number for the highest bracket here. That's because these would apply if your income is high enough that you're subject to the net investment income tax, but that applies only to marginal adjusted gross income for joint filers. That's $250,000 and higher, or $200,000 and higher for single individuals. The point here is that if you have long-term capital gains income, it is taxed at a lower rate, a preferential rate, compared to your earnings. And this is something that will come into play when we talk about thinking about, if you're investing, where are you owning certain kinds of investments? We're going to talk about something called asset location in a minute. But first, let's talk about those tax brackets. Remember I said if there's a time when you're in a lower tax bracket that may present an opportunity, you want to take advantage of swings in income that put you at sometimes in lower tax brackets and other times in higher tax brackets. Because in your lower income years, you might choose to increase income or not take deductions that you could get some benefit later on in exchange for. So when you're early in your career, making less than you might in your mid or later career, if you go through a period of unemployment, or another time when lower income years can happen is if you retire before you have to start taking RMDs from your retirement plans. Maybe you retire and you haven't yet filed for Social Security. You could have, and you could certainly choose to have, a few years in there with very low reportable income. These are opportunities to pull income into those years so that you won't have to report it later on. How would you do that? You could fill up your current lower tax bracket by, if you got some savings bonds on hand that have accumulated interest, you could cash those in, get the interest tax now while you're in the lower tax bracket. If you're a working person and you're contributing to a retirement plan, you could choose to put money into a Roth version as opposed to a tax deferred version. Remember my niece who didn't really need the tax deduction because she was in low income in those very early years she was working? She chose the Roth for this very reason. If you have investments or other kinds of assets that, when sold, will generate long-term capital gains, you might choose to sell those, pay the long-term capital gains tax, if any, while you're in these lower tax brackets, because it could mean that your long-term capital gains rate is 0. Remember, if you're in the 10 or 12% marginal tax bracket, or if you're in one of the middle ones, only goes up to 15. And then you repurchase something similar or even the same thing. You may have heard that there's something called a wash sale rule where you can't sell and then buy the same thing within 30 days. That only applies if you're claiming losses. If you're selling at a gain, you can turn around and buy the same thing. There's not a problem with that. Now, since we've talked about that, I have to give you a caution. Don't go crazy with this idea because there is a limit. Even if your ordinary income puts you in the 10 or 12% tax bracket, if you have enough capital gains, your total income will move you up into the higher tax brackets. So limit how much additional income you are creating by looking at what your total income is going to be, your total taxable income, and trying not to move into the higher tax bracket where the higher capital gains taxes will kick in as well. And I've given you those limits here. So your total taxable income is the number that drives this. It is your ordinary income plus your long-term capital gains and qualified dividends. basically taxable income on your 1040. Your long-term capital gains tax rate will be 0% until this total taxable income hits about $42,000 for a single person. These are 2022 numbers. Or for married filing jointly, 83,000. It will be between those numbers and the next ones, you would pay a 15% capital gains rate until you exceed, up into $400,000 and $500,000. At that point, you pay the highest capital gains, long-term capital gains rate, which is 20%. Okay. So when we talked about the early career person and ways to utilize the lower tax brackets that you're in the early years of your career, when presumably you're making less money. Another time when we can use some different strategies to fill up those lower tax brackets is when we're between the ages of 59.5 and 72. Why those numbers? Starting at age 59.5, you may be able to take money out of a retirement plan without paying an early distribution penalty. Before age 59.5, the general rule is penalties for early distributions, 10% of what you take out. Age 72 is now the age at which required minimum distributions kick in. So between 59.5 and 72, you have carte blanche. You have total control over whether you take any money out of retirement plans or not. So what some folks are finding to be advantageous is that they're taking voluntary distributions from their retirement accounts during these years. If you've either stopped work or you suffered a reduction in income for other reasons, take voluntary distributions. Now you might be saying, well, I don't need the money. I've got other money to live on. I don't need to take money out of my retirement accounts now to live on. Fine. If you don't need it to live on, convert it to Roth. You still created the taxable income while you're in these low income years. What that does is it results in smaller future RMDs, required minimum distributions, which in turn are going to probably reduce your future income tax rate and could reduce the amount of Social Security that is subject to income tax as well. It's almost like a circular argument that reinforces itself, reducing your RMDs and therefore, reducing other things as well. So what if you're in high income years? Well, then we reverse everything we just talked about. If you're in your working years, contribute to a traditional retirement account and get the reduction in taxable income now. Don't put money into a Roth. If you've got appreciated assets, whether it be investment properties or stocks, mutual funds that hold stocks, this is probably not tax-wise the right time to sell them. There may be other reasons you want to sell, but you wouldn't sell them during your highest income years just for tax purposes. On the other hand, if you have investments that have lost money, you may want to sell some of those to harvest tax losses. This is actually a concept, tax loss harvesting. You can Google it. It's a popular strategy. But this is where that wash sale rule would come into play. If you sell stock X or mutual fund X at a loss and you turn around and repurchase it within 30 days, or you purchase some of it in the prior 30 days, then you're going to be denied some of that loss that you were trying to claim because of the wash sale rules. Can't buy the same or very similar investment within 30 days on either side of something that you're selling at a loss and trying to claim the loss. Are your eyes glazing over yet? How you doing? This is the only time when I really regret not having people in person, because it would be kind of fun.
Well, here, I'm the one other person. I'm the one other person and I'm here. Just want to give you a chance to pause and catch your breath, maybe a sip of water if you choose. We do have some questions that I'm just replying to, saying that as time permits, you'll address near the end. Okay. And let me add to that. If by chance you've posted a question and you have to leave before we get to your question, on my website, which will come up again toward the end, but I posted it, we saw it on one of the earlier slides, so it's going to be in the slide deck that Patty will send you. If you have a question we do not get to, there is a tab on my website called Contact Karen.
and you can post your question there. I try to respond to requests for factual information. I do not do advice. So I won't, I will tell you that I'm not answering if you're asking for advice, but if you're asking for, confirmation of you're saying what you think you understood or what have you, I will try to respond to those if we don't get to them tonight. Thanks, Patty. So number 8. We have retirement accounts in this country that were set up with tax benefits. The tax deferral on the traditional type of retirement savings plans, the tax-free growth in the Roth plans. The best thing we can do for ourselves with those is to try to make sure that we're maximizing the tax benefits that we can get from those. And to a certain extent, it's kind of simple. We just want to avoid penalties. We want to maintain tax deferral and not inadvertently cause ourselves taxable income. And there's even one way to avoid tax on some of your required minimum distributions legally. So let's start with what the rules are for owners of retirement plans. I alluded to this earlier. If you take distributions before age 59 and a half, you will typically be assessed a 10% early distribution penalty on top of any income tax that you're owed. Now, there are exceptions. I'll leave that to you to either look up, or I'm pretty sure I have a link about those on my website. You can move money between retirement plans, but what you want to do is you want to use what's called direct rollover. If it's moving from an employer plan to an IRA, this is the correct technical term, direct rollover. If you're moving things between IRAs, technically it's called a trustee to trustee transfer. But if you say direct rollover, people will know what you're talking about. It means that the money goes directly from custodian number 1 to custodian number 2. The money did not come through you. You never had control of it. Therefore, it cannot be deemed a taxable distribution. You want it to go directly from the first account to the second account so that the tax deferral is maintained or its Roth character is maintained. We're maintaining the tax character of the money by doing a direct rollover. The third thing that you want to pay attention to avoid penalties is, oh, and by the way, the reason you want to do direct rollovers and trustee to trustee transfers is because of what happens if you take the money out yourself and go to redeposit it. First of all, you have to get it done within 60 days. And when you get the money, you don't get all of it because they're going to do tax withholding. You're going to go have to find money to make that up so you can redeposit the whole amount. And if you don't redeposit the whole amount, whatever amount you don't roll over will be a taxable distribution, and there's really no getting around that. So direct rollovers will save your butt, to be blunt. Okay, third point. You'll have annual required minimum distributions starting at age 72. You have to take them by December 31st. However, the first required minimum distribution, the deadline is April 1st of the following year. You've got a grace period, January 1 to April 1st, that you could not do it. Let's say that your first RMD is next year, 2023. You can take your first required minimum distribution anytime during next year, or you could wait until January of 2024 or February or March of 2024. But your second RMD is going to be due by the end of 2024, okay? Because you have to take one for 2023 and you have to take another for 2024. And if you don't take an RMD by the deadline, the penalty is 50%. Don't mess with that one. We have owners of retirement plans and we have beneficiaries. If you have inherited a retirement plan, there are some new rules that were effective in 2020. Now, the thing that determines whether you're under the new rules or not is when the person passed away. If they passed away before in 2019 or earlier, you're under the old rules, keep doing what you're doing. But the new rules that went into effect in 2020 said that all beneficiaries have to deplete the inherited account within 10 years with these exceptions. If you're the spouse of the deceased, if you are disabled, if the beneficiary is a minor under 18, but once they hit 18, then they just have 10 more years. Or if you're close enough in age to the deceased, if you're within 10 years younger than the deceased, then you can use life expectancy rather than having to empty the account within 10 years. This was a lot of brouhaha about this. There's still some gray stuff about, did you have to take distributions every year, or did you just have to empty it by year 10? The current interpretation is you do have to take an RMD every year, and you have to take the balance out in that 10th year. But let's go back to the spouse beneficiary, the spouse who inherited this retirement plan. They have some special rules. First, the decision to leave it in the name of the deceased, which means, oh, I'm going to treat myself as a standard beneficiary. I'm not going to use my spousal rights. And I have to empty the account within 10 years. In some cases, that might be what you want to do. But the alternative is that the spouse beneficiary treats the account as her own. She takes ownership, typically by putting her name on it. But in that case, she's the owner. She takes distributions over her lifetime. And then when she passes away, a beneficiary will have an additional 10 years to take it out. And now the thing you've been waiting for, the way to take money out of an IRA after you reach age 70 and a half, that's not a typo. This is still 70 and a half, even though RMDs are now age 72. This is how you take money out and owe no taxes. First, it's only for IRAs. However, the amount is pretty liberal, up to $100,000 annually. It will count towards your RMD. It will fulfill your RMD. So if your RMD is $20,000, you can take the whole $20,000 and do this with it. If your RMD is $20,000, you can still do the $100,000 as a charitable distribution. It has to go directly to charity. This strategy of making charitable distributions for most people is going to have significantly greater tax benefit than the way we used to do charitable contributions, which was by taking an itemized deduction. Remember, most people today aren't itemizing. And so I want to, I thought I had an example in here. Maybe we'll get to that. But doing a qualified charitable distribution will give you a reduction in taxable income dollar for every dollar of charitable distribution that you take from your IRA. If you do the standard itemized deduction, you have to get above the standard deduction amount before you get any benefit from charitable distribution. So for most people between now and 26, anyway, this is going to be the preferred way. Has to be done from an IRA. You have to be age 70 and a half on the day of the distribution, and the money has to go directly to charity. The one situation that I'm aware of where this would not be your best strategy is if you're donating appreciated assets. If you're donating appreciated stock, appreciated real estate, talk to a good tax advisor before you make those kinds of contributions. All right. When we sell our homes, there are some tax breaks available here as well, where you might avoid tax on part or all of the profit on your home. The tax break is an exclusion of $250,000 of profit for both you and, if you're married, your spouse. And so you take the profit on the house minus your exclusion or exclusions that are accessible to you, and the remainder, if any, is taxable income. You have to own and live in the house for at least 2 of the past 5 years to qualify. It only applies to primary residences, and you cannot have used this exclusion within the past 2 years. And if you have any non-qualified use, meaning it wasn't always your primary residence, if you have any non-qualified use more recently than January 1 of 2009, let's say it used to be a rental home or it used to be your vacation home, the amount of your exclusion will be reduced in respect of that non-qualified use. The main thing to be aware of here are ways that you could mess up that exclusion other than the non-qualified use. If you move out of the home and wait to sell it later, if you wait more than 3 years, then you've lost your exclusion. If you're getting married or divorced, especially if you're planning to buy or sell more than one home, work with a tax person who understands the rules about this. You could lose part of your exclusion if you don't sell the homes at the right time regarding before or after the marriage. If you're in a situation where you were married, your spouse has deceased, you can use your deceased spouse's exemption if you don't remarry and if you sell within 2 years of the date of death. Beyond 2 years, or if you remarry, you've lost your spouse's exclusion. Okay. Final point here is not just about income tax, but thinking about your beneficiaries, your heirs' tax rates as well, so that you can compare the value of making lifetime gifts versus leaving an inheritance to someone when you pass away. The concept we have to focus on here is tax basis. When you sell an item, you have to know what is your tax basis. Now, generally, that's what you paid for an asset, although that number can get adjusted. For instance, if it's a house and you made improvements to a house, that adds to your tax basis. If it was a rental home and you took depreciation, that reduces your tax basis when you sell. This is important because gifted assets have a different tax basis from inherited assets. Gifted assets keep the tax basis of the original owner. So let's say I've got some sort of investments that I bought for $10,000. I give it to my niece and she sells it for $50,000. She kept my tax basis of $10,000. She has $40,000 of taxable gain. If though I held that until I died and she inherited it, she would only owe tax on the difference between the value on the day I died and the day she sold it. Could be a big difference. Here's an example. Let's say that whatever this asset is that we're talking about, I bought it for $75,000. And when I die, we're going to say it's worth $200,000. Maybe my niece eventually sells it for $225,000. The question is, how much tax does she owe? And it depends on when she got it. If I gifted it to her, then when she sells it for $225,000, her tax basis is my purchase price. $225,000 minus $75,000, she pays tax on $150,000. On the other hand, if I waited and left it to her upon my death, she sells it for the same $225,000, but her basis is now the value on the date of death, $200,000. She only pays tax on $25,000 of capital gains. A couple of words now aimed at married couples. Taxes will change after the death of the first spouse. And you probably will not end up owing a higher dollar amount of taxes, but you may be in a higher tax bracket. The rate of tax that you pay could go up. And it's because, yes, your income is going to drop, but probably not by 50%. On the other hand, there are things that you can do to pull income into the time when you are both still living. One is to take more of those voluntary distributions from traditional retirement accounts. And if you don't need the money, just convert it to Roth. Cashing in savings bonds, selling those accumulated, appreciated assets. And a rule that can help somebody think about managing a tax burden between the time that you're married and both alive versus for the survivor is to recognize that things that are still owned jointly at the time of death will receive a step up in basis, just like we were talking about inherited assets on a previous slide. The survivor will get a step up in basis on the half of that asset that was viewed as owned by the deceased. And so selling after the death of the first spouse would result in less profit and possibly less tax. However, that survivor could be in a higher tax bracket because of the fact that the income probably did not drop by a full half. Here's an example. Let's say that, again, we've got an asset that the basis, the purchase price was $80,000. At the death of the first spouse, let's say it was worth $200,000. So we have to calculate a new basis at the death of the first spouse. Well, this $200,000, half of that is deemed as being owned by the deceased. And so we get to take half of that as basis from the deceased's half. So that's $100,000. And then for the spouse who's still living, we take the original basis. Half of that is the basis for the survivor's half. So half of $80,000. We end up with a new basis of $140,000 after the death of the first spouse. Let's say we eventually sell this for $225,000. Again, the question is, how much taxable income is there, depending on whether it was sold before the death of the first spouse or after? If it was sold before the death of the first spouse, we would take $225,000 minus the original basis, $80,000, and taxable income of $145,000. If we waited until after the death of the first spouse, we would have the same amount that we sold it for, but we'd be subtracting the increased basis because it got a step up in basis at the death of the first spouse. Only $85,000 would be taxable at that point in time. I should come up with a different slide to end on because talking about death is not the most uplifting thing in the world, but these are realities. One of the hard things about talking about personal finance is if I did see you in person, I know what you're looking like right now. You may be intent, but you're very serious. And so in my next life, my plan is to come back as a motivational speaker, because then I'd get to see you going, quite a difference. But at any rate, this is where we are. I've mentioned the place on the website where you can go for links to resources to learn more about the things we've talked about tonight. There's also that Contact Karen tab where you can send me a question if I don't get to yours tonight, or to sign up to know where else I'm presenting in the coming months. And with that, Patty, how many questions do we have?
Well, I think this is going to turn into possibly a slumber party of a Zoom presentation with the library, but I will let you filter through those questions. I think you have access to view the same ones that I do. We have, taking a look here, and they're coming in two different routes. If you want to address the ones in the Q&A first,
Okay.
I think we have 3 in Q&A, and I think we may have 7 in the chat.
Okay, so I'm going to start with Q&A. And so if you have a question you haven't posted yet, please post it in chat, because once I get through these 3, I'll be looking at chat. All right. First question. If you don't itemize, and if you are filing single and doing the standard deduction, charitable donation contributions do not benefit the taxpayer in any way. Correct. That is correct. The only exception would be if your charitable contributions are substantial enough that combined with the other itemizable costs that it gets you above the standard deduction amount. But for most people, that means that you'll have several $1,000s of charitable contributions that you didn't get any benefit from. It's unfortunate that that's a disincentive right now for charitable contributions. The only alternative is, if you are old enough, if you're 70 and a half, that you could do the qualified charitable distribution from an IRA and get value for every dollar that you contributed. But yes, anonymous attendee, you understood that correctly. Okay, Deborah. I was under the impression that a portion of capital gains is taxed at 0 tax rate up to $40,000 and then 15% over $40,000 for single persons. For example, if I had 60,000 of capital gains, 40,000 would be at 0% and 20,000 at 15%. Your slide made it look like if I'm in the marginal tax bracket with regular income of 24%, then I would pay 15% on all $60,000 of capital gains. Deborah, I think the way you understood my slide is the correct interpretation. It's the reason it's kind of hard to understand is it's not as if we silo ordinary income and capital gains. And so with capital gains, that's why you don't start necessarily at the $0 amount. You actually have to look at the total amount of your combined taxable income, ordinary income and capital gains and qualified dividends together. That's what determines the marginal tax bracket that you're in. And based on that marginal tax bracket, that's what determines which tax bracket for capital gains you're in. You don't drop back to 0 if you're already in the 24% marginal tax bracket. You start in the 15%. This is also why the physical worksheet to figure this out is a full page in 9-point font, and it took me an hour and a half to work through it for myself to make sure that I understood this. And so now I'm glad I spent that hour and a half, because I can tell you that you're correct with your second explanation here. You do not start out at 0% capital gains tax if you are already in the 24% tax bracket based on your total income. The only way you would start out with absolute 0 for capital gains is if you had no other income. And yes, then you could have the full $40,000 of capital gains at 0%, and then additional tax at 15%. That would be if you had no other money, but the other money works into the calculation. Hope that answered your question sufficiently. Okay, number 3, if you don't give advice and I need a specific question answered, I could use a financial advisor. Fiduciary. How do they charge for their time? Hourly, minimum amount of time? Are these questions we should ask before making an appointment? Barb, the first thing I have to say to you is, yeah, you've already got the main concept of a fiduciary is who you want to be working with. That means that the person should be a registered investment advisor as opposed to a registered representative, AKA broker, which is regulated as a salesperson. On my website, just as I have a page about smarter tax return, there's also a page about finding financial advice. And so if you go to KarenChanFinancialEd.com, go to the resources tab and choose the topic that starts with finding financial advice, you'll find a bunch of links there that will help you understand the types of financial advisors we have in the United States, places that you can search for candidates. And there are at least two sources I've linked there that are limited to fee-only financial planners. The third one, they are all going to be fiduciaries, any of the links that I have for sources for you there. So I hope that helps with that. And yes.
Well, Karen, thank you so much for that one. So that wraps up the Q&A, which I'm really glad we got through those 3. We're going to move on over to chat. So if anyone has any additional comments or questions, we're just going to concentrate on chat. I have had a request. Some of the chats have come through just to you and me, Karen. And so I've had a request not to identify names in those.
Will do. Okay, I'm starting from the top. So I think we'll start at the beginning. Okay, question is, are there chances Roth IRAs will become taxable later on? Never say never, but I think highly unlikely. Even if they found a way to have any tax on the growth in the account, they could not tax your contributions because they have already been taxed. And I just don't think that we're going to see taxation on the growth as long as you meet the criteria. Account open at least 5 years and you are at least 59 and a half disabled or deceased at the time the money comes out. What happens when you leave the job with that employer who provided the health savings account? Excellent question. The good news is it is your money. You can leave it in the account that was set up by your employer. You can roll it over to another HSA with a different provider. It's your money. You will not lose it when you change employers. That's the value of that type of program. How does the FSA money grow if you do not request reimbursement? Flexible spending account money does not grow. That is the use it or lose it plan that you must deplete the account by the end of the year. It's only the health savings account that we just talked about that can grow. And it can grow because you may be required to keep a certain amount in basically a savings account, but beyond that, you would be able to invest it typically in mutual funds. And so that's how you can actually experience significant growth in your HSA if you hold it over a number of years. Okay, a longer one here. Let me try to expand this. Can I expand this screen? No. Okay. My son is selling some of my business machine parts using his eBay account. He would receive the 1099K, but he is in a much higher tax bracket. Ooh, what do I need to do so I am paying the taxes which are much lower? Because this is brand new and because I have not actually had training in this, I'm going to say I don't know. But what I do know is you should be talking with a tax advisor ASAP. Now that person could be a general financial planner who has expertise in taxation, or you might want to go straight to a CPA or other tax professional. But in this situation, if he's doing the selling, partly I'm not sure if there's anything that you can do here. I'm not sure. There are also rules about whether this would really be profit or not. So I think there are several questions here. I can't answer them. So look for an accountant or other tax professional who can help you with that. I'm sorry, I can't be of more service, but at least you're alerted to the problem or the potential problem. So you can check into it now. Okay, slide 33, was the total referring to your total income or just the capital gains? Okay, I'm going to have to go back to slide. Thank you for telling me the slide number. Was the total referring to your total income? These numbers are referring to, as it says in the first bullet, total taxable income. So it's not gross total income, it's taxable income. So this is after your standard deduction and any other adjustments to income, but it includes both your ordinary income and your long-term capital gains and qualified dividends. Yeah, you are correct. It is the total. Okay. In January, I converted 401k dollars to a Roth IRA. Should I send in tax money before 12/31 to avoid a penalty? Very possibly. If you can, do a quick back of the envelope calculation to try to make a guesstimate of what your income taxes are going to be, how much total you're going to owe for 2022. If the amount is over $1,000, yeah, then do if you're employed, the best way to do this, if possible, is, oh, we're so late in December though. If you can get additional taxes withheld from any remaining paychecks this month, do that. If not, make an estimated tax payment. The three ways that you might avoid a tax penalty is an underpayment penalty would be if the amount that you've already paid through either withholding or estimated taxes is 100% of the amount of tax that you owed last year, then you should be exempt from the underpayment penalty, or 90% of what you owe this year, or the amount of underpayment is no more than $1,000. Any of those three things should avoid the underpayment penalty. The problem with making estimated tax payments now is that you should have been making them through the course of the year, especially since that conversion happened way back in January at the beginning. So you may not be in a position where you have control here, but definitely worth going ahead and paying the estimated tax now rather than when you file your taxes. It may save you some interest if nothing else. Okay. I had my investment joint tenants with right of survivorship. I'm not sure what maybe you mean account. I had my investment joint tenants with right of survivorship account with my husband liquidated without my consent. Half of the assets were repurchased within 15 days for my own account. These assets were purchased at a lower price than when sold. Could you explain if this affects my taxes owed as a wash sale? It depends on whether the assets that were sold at a profit. If they were sold at a profit, there is no wash sale problem. The wash sale rule only comes into play if you sold at a loss and you're trying to claim a capital loss instead of a capital gain. So I hope that answers that question. And if I don't fully answer a question, you're welcome to come back and post again. Can we claim losses to offset investment gains if my primary residence was sold at a loss? I was with you until I saw the primary residence. Losses on primary residences are not deductible, I'm sorry to say. You can avoid tax on the gain, but you cannot subtract a loss on the sale of a primary residence. I missed the first 30 minutes, so please ignore if this is already answered. Do we owe taxes in the state of Illinois checks sent out of the blue for $200 and $300 to property owners? No, you didn't miss it. We didn't talk about it. It's a great question. And no, you don't. That was sort of like I'm not quite sure how to label it. It's almost like an extra tax refund that is not taxable income. No need to sweat that. But yeah, it's a very fair question, because I did talk about other kinds of unexpected income that could be taxable. What form do we have to submit to the IRS for adjusting the basis of inherited property? Okay, I'm going to start by saying that to a certain extent, this is sort of depending on the truth of the filer. However, there are some records that may be pulled in. It depends on what was sold. Okay, actually, let me back up. I was not thinking of your question thoroughly. The question is about the basis for inherited property. The role of the executor upon a death is to identify and value the assets of the deceased. That is a report that gets filed with the court. And typically, any beneficiaries would receive a copy of that report as well. So if it's something that, if it's a publicly traded asset, you can also look up the trading, what it was selling for on the date of death. If it's something like a piece of real estate, something that's not, it's not a stock, it's not a mutual fund, it's not a bond, then you would need to use the value that was determined by the executor. Typically, they would have hired an assessor or an auditor to do that sort of thing. So publicly traded information, look it up. You know, we used to say on the newspaper, now look it up online. For other personal property types of things, real estate and so forth, look at the accounting done by the executor. Failing that, maybe ask a real estate agent to help you identify comparable properties the same way they would try to establish value for a property that they were listing. Hope that helps with that. When total income is only through cashed stocks and bonds before the age of 72, do you need to pay quarterly taxes for your anticipated income? And so the individual who asked this, if you heard my answer to the previous person about how to avoid an underpayment penalty, that you either have to have paid through estimated taxes and or withholding at least 100% of the taxes that you owed last year, 90% of what you end up owing this year, or if the amount owed that's not been paid already is less than $1,000, that's how you avoid an underpayment penalty. The source of the income is actually irrelevant. And so one of the rude surprises, and maybe I should add this somewhere, one of the rude surprises of being a retiree is that you go from having paychecks where you had withholding to having sources of income that often don't have automatic withholding, just as you said, you know, the selling of stocks and bonds and so forth. So yeah, this is a rude surprise. Now, here's something that I think I'm correct about. If this perchance is your first year of retirement, I think there is a waiver for that 1 year. If that doesn't apply, then the best thing I can suggest is, as I said to the other individual, go ahead and pay estimated tax for this month or for this fourth quarter, even though ideally you would have been paying it across the year. Better to get it done now than not. If there are any additional sales that are going to happen, or if you might be taking voluntary distributions from a retirement account, requesting to have withholding from those profits would be one other way to try to deal with that. Sorry to be the bearer of bad news there. How much is the standard deduction for married filing separately on the 2022 tax return? Oh, you would ask me that, wouldn't you? I am pretty sure. I want to say that it is half of the married filing jointly. However, I know that sometimes married filing separately has a whole different set of rules. And so I would actually have to look that up. So I'm going to ask, if you don't mind, you can look it up online easily enough. It's just a quick Google search. But if you have difficulty finding it, go to my webpage and send me that question and I will look it up for you. But I'm afraid that I'm going to tell you wrong if I say for sure. Okay, question is about those third-party payers. You mentioned third-party payers, PayPal and Venmo, that you'll receive a 1099-K. How about Zelle? I think Zelle is going to fall under the same rules because it is a third-party payer. The difference is probably going to be that Zelle typically is used person to person, not used as typically by businesses. However, they probably still fall under the same rules. So if you hit that $600 total amount, or if it appears to them that these were business transactions, you might still get a 1099-K. I just think by the nature of Zelle, it's probably a little less likely. But this is so new that I really don't have enough information or knowledge to answer with confidence about that. Okay, when I was divorced, our home was assessed. And I paid to my former spouse the difference between our purchase price and what the home was currently worth. When I sell the home, what is considered to be the basis? Okay, now that I know the question, I'm going to back and reread for the beginning. When I was divorced, our home was assessed, and I paid to my former spouse the difference between our purchase price and what the home was currently worth. When I sell the home, what is considered to be the basis? Okay, I have to start off by saying I have never actually seen this question before. So technically, I do not know the answer. However, I believe this is a situation where the reporting that's required by the IRS is very minimal. If you end up not having any profit on the home, or if the profit is less than $250,000, there is no tax filing, if I recall correctly. So the only time you would file tax is if the profit was more than $250,000, assuming that you're qualifying for the full exclusion. And then the question is irrelevant. Now, I believe that by paying your ex-spouse for that additional value, I would think that that did add to the basis of your home. And so I think that your profit would be calculated adding that amount to the original cost. Whether that is technically correct or not, I don't know, but I think you could certainly make an argument to the IRS that that makes sense. And as I said, unless your profit comes out to be more than $250,000, you don't have to actually report anything anyway. So unless you have a large profit to report, I think this is a moot point anyway. But I understand the concern though. Speaking of taxes on Roth IRA growth from contributions previously made, and if you're older than 59 and a half, it is assumed to be tax-free, correct? Yes, if you have had a Roth IRA account open for at least 5 years. you have to meet the 5-year requirement and the age requirement. The only time that there's a different clock is if you did a conversion of traditional money into the Roth, and then there's a different clock that's used. But in this case, as long as you've had the Roth IRA or any Roth IRA open for at least 5 years, and specifically whatever year you opened it, you're treated as having opened it on January 1st of that year. So they give you, they give you all the benefits here of being lenient. But if you've had it open 5 years, you're good to go. Okay, and here's the question. Yeah, okay. So this is a follow-up comment to the question about selling somebody, selling investments and then repurchasing at a lower price. She says that indeed they were sold at a gain, so there is no wash sale concern here at all. That's good news. Okay, and then there's a question about talking a bit more about the widow penalty. I did gloss over that a bit. Let me go back here. So the way a survivor could end up sort of being penalized by the tax system is that, as I said, your income's going to drop, probably not by half. And the tax brackets are not exactly half either. And so it ends up that you could be in a higher marginal tax bracket as a survivor than you were as a married couple. Consequently, that could mean you're in a higher long-term capital gains bracket as well. And if your income is high enough, you know that if your income is above certain limits, you pay more for your Medicare premiums and for your prescription Part D premiums. So you could more easily find yourself paying that additional premium for your Medicare and Part D. And the larger Social Security benefit of the two between you and your spouse, the larger benefit lives on with the survivor. And now you're talking about being in a higher tax bracket already. You could end up with more of your Social Security benefits being taxed as well. Now, there are situations where this doesn't add up to much. There are others where it kind of starts, each individual impact here might not be that much, but total, you might be surprised at how much tax you're owing. And so the best suggestion I could give you is to, at this point, try to do a quick calculation of what your income is going to look like this year, how much tax you are going to owe. And the first thing you'd want to do is, as we've been talking about, if it looks like you're going to have underpaid your taxes through withholding and or quarterly estimated taxes, try to rectify that by either higher withholding, if you can get that done on the last check of this year, maybe before the 31st, or paying additional in your estimated taxes. It still wasn't done equitably across the year, so it might still technically be an underpayment. But that's what you're worried about, is just getting caught like that. Okay, let's see what else we have here. Oh, somebody's asking, why would a married couple file separately? Okay, I'll start out with the worst case scenarios. The worst case scenario is you think your partner is lying or hiding income, maybe committing fraud with the IRS, and you don't want to be associated with it, so you file separately. That's like the worst reason, but the most important reason to file separately. Another actually very, I don't know how common it is, but a totally understandable one is if you have student loans, there are situations where filing separately helps you with the calculations of your student loan payment under the income-driven plan, and it can make a huge difference depending on the particulars of your situation. Those are the two most common things that I can think of. Another might be where someone has extreme medical bills, where if they file separately, they would be able to itemize and maybe end up together owing less tax than if they had filed jointly. So a variety of reasons, but the typical situation is for a married couple to file jointly. It has to be a rather unique situation before it's beneficial to do otherwise. I'm self-employed as a realtor. I have not set up tax withholding. Can I prepay tax, and what form can I download from the IRS to prevent penalty? Okay, what you want to do, they're called estimated tax payments. They're done quarterly estimated tax payments. You can set up an account at irs.gov to make those quarterly payments. And even though you haven't made any so far, paying now would probably be preferable to waiting until you file. And then next year, do it proactively. They're due, I think the first one is actually due April 15th. The second one is due June 15th. The third one is due September 15th. I'm doing this from memory. And I think the fourth one is due January 15th. They're not due every 3 months. That's why it's kind of hard to remember. So yes, do look into that. IRS is actually not a bad website to read up for this sort of stuff. So don't be afraid to go to irs.gov and do a search on the topic that you're concerned about. They actually have very good guidance there. It's not a bad website to use. What do you recommend if I pass the e-file deadline for getting a refund? How late is too late? You have 3 years from the due date to file and still be able to claim a refund. Even if you can't e-file, you can paper file. Paper files are really backed up right now. They have still not recovered from the backlog that developed while people couldn't work in the office during the pandemic. Filing sooner than later, but you do have 3 years to file to get a refund. There is no deadline for having to file if you owe taxes. You will always need to file and make those payments. But if it's a refund you're due, you have 3 years to get that done. And I think that's it. Great questions, everybody.
Karen, you really ran through the gamut. Definitely do a victory lap here. I want to say thank you to everyone who made time to join us this evening. I'm very, very pleased that the presenter was agreeable, and we are going to be posting this on our YouTube channel should you want to go back and recap any of the information that was shared tonight. I just sent out your handouts a few moments ago to everyone that had registered and attended tonight's program. So again, we appreciate you sharing that with us, as well as the wealth of content that came here.
My pleasure. And I'm so glad that my internet lapse didn't keep me out, that I was able to get back in.
We've invited Karen to come back again, of course, to present. We try to secure her at least 2 times a year on her dance card. And so we have a program pending, a couple different topics we're discussing for April. So please do take a look at Karen's site, where else she might be presenting virtually, as well as when we will be hosting her next spring. But thank you, everyone. Karen, we're very grateful for you.
My pleasure.
Good night, everyone.